Hi there, welcome along to this Kaplan Masterclass on investment appraisal. My name's Andrew Mower and I'm a tutor at Kaplan Financial. So the plan for this short video is to run through the main types of investment appraisal. Now, just to remind you what investment appraisal is about, a company might be looking to choose which project to do. So they might have a range of different projects that they need to decide on or different investments that they need to make a decision on. And we're going to use these techniques to decide which of those investments are going to be best for shareholders. Which of these are going to really make those shareholders happy and maximize their wealth, which is often the aim of financial management, to maximize shareholder wealth. So we've got these four techniques we're going to look at today. The first one is called the accounting rate of return, otherwise known as the ARR. We're then going to move on to this thing, the payback period. We're thirdly going to look at NPVs, the net present value. And finally, we'll look at the internal rate of return, commonly known as the IRR. So these are the four techniques. Now, for each one, what I'm going to do is just give you a quick overview of what it's about. I'm then going to do an example. So for each one, I'll do a little example just to give you an idea as to how they work. And then we're going to look at the advantages and disadvantages of each as well, because in a lot of exams, they like you to then discuss the method that you've used or to consider the weaknesses of particular methods. So I thought it'd be worthwhile just recapping the main advantages and disadvantages of each as well. So you've got quite a nice little overview of each of these four types of investment appraisal by the end of this session. So this first one, the accounting rate of return, the ARR, just be careful. This is also known as return on capital employed, ROCE, for a particular project. So they do sometimes mix up the name, but we're going with this thing, the ARR. And what this is the average annual profit before interest and tax. So PBIT, profit before interest and tax, divided by the investment that you've made in the project. Now, there are two ways of dealing with that investment, which we'll explore in my example in just a minute or two. So all this is doing really is just giving you a percentage return on your investment. So if the answer comes out as, say, 15%, what we're saying is this is giving us a 15% return on the investment we made on this project. So it's a nice, simple measure that's widely used. A lot of people will use this to compare projects, and it works nicely at projects of different sizes as well. Let's have a quick look at an example then. So I've just made up some nice, easy numbers here. We've got this 4-year project. We're making the initial investment of 150, scrap of 50, and then we've got PBIT, so profit before interest and tax, of 60, 50, 80, and 30 across the 4 years of the project. Now, we often assume in financial management that we're not going to earn any returns on our project in year zero. So year zero is today. That's when we're buying that machinery or investing in this particular project immediately up front. We then assume that we start getting returns from that a year later. So in year one is where we start getting those returns. So you notice there's not a PBIT figure in that year because, like I say, we're not going to buy the machine today and instantly made loads of money from it. So we assume that they start a year later. So if we think about, first of all, the formula says we need the average annual profit before interest and tax. So all I'm going to need to do is take the average of these four figures here. So I'm just going to need to take the average of those four figures. And hopefully you're all okay with averages. If I just add them up and divide them by 4, that will give us the average annual profit before interest and tax. So sure enough, if I do that, we end up with 55. So that's the average profit before interest and tax is 55 if you add up the 4 numbers and divide them by 4. So that's the top bit of the formula that we need. That's the average annual PBIT. What we now need to do is divide it by the investment. As I said, there are 2 ways of doing that. The simplest way probably is just to divide it by the initial investment. So firstly, what I'm going to do is just do 55 over 150. What is that as a percentage? And if I do that, if we use the initial investment, so 55 over 150, we end up with 37% is our average return. So that's the accounting rate of return. That's the percentage return we're getting on our investment each year. Now, what that doesn't factor in is this scrap. Do you remember we said that we were going to sell it for 50 after 4 years? We haven't thought about that yet. We haven't brought that into it. So what you can do, instead of using the initial investment on the bottom of this formula, you can take the average. So what you do is you take the average of what you paid for it and what you sell it for. So we buy this thing for 150. but then at the end we sell it for 50. So it's only really cost us 100, isn't it? If you think about that, it's only really cost us sort of halfway in between those two things. So what we do is if you do 150 plus 50 gives you 200, divide that by 2. So we're just taking the average of the two things. So halfway between what we bought it for and then what we're selling it for at the end. So if you do that using the average investment instead, so that little bit there is just taking the average of the two figures. So that's 100 you end up with there, isn't it? Halfway between what we bought it for and what we're selling it for is 100. And we're doing 55 over 100, which obviously gives us 55%. So it's a different way of doing it. And in most exams that I teach this stuff in, they tell you which way they want you to do it, either using the initial investment method or the average investment method. So you've got a couple of ways of dealing with that. And obviously they do give different answers, so they would need to specify. Okay, so that's the ARR, little example of the technique, nice and straightforward, hopefully. In terms of good things about this, as I say, it's quick and easy to do. It does take into account the whole life of the project. Because it's an average annual PBIT, we are thinking about the whole life of the project, which is good. And it's also a relative measure, which is a percent. That means it's a percentage. And that's good in some ways, as we'll see in a minute. Sometimes it's not, but it does allow you to compare projects and investments of different sizes. So, whether this is a £10 million investment or a £10,000 investment, you'll still be able to compare, and you'll get something relative out, which is quite nice for those comparisons. However, it does use profits. This is one of the few investment appraisal techniques we do that uses profit. Most of the others will use cash flows. Now, we don't particularly like using profits. Profits they're just theoretical, aren't they? They're just an accounting thing, and it depends on your depreciation policy, and it depends on revaluations and all sorts of different things. Whereas cash flows are much more factual. You can spend cash, you can pay out as a dividend. So we prefer using cash flows, and the fact that this uses profit is a weakness. It ignores the time value of money, which is that idea of discounting cash flows. We're saying that 80,000 in 5 years' time or whatever is still worth 80,000 today. It's not. We aren't discounting things yet, so it's ignoring the time value of money. And also, these percentages can be misleading. So these relative measures, although they're good for comparisons, if we're just looking at the percentage, saying, oh, this project's got an ARR of 75%, you go, wow, that's incredible. But it might be that that's because it returns £75 on an investment of £100. And you think, oh, actually, this is a really, really small, low-key project. Whereas one might have an ARR of 60%, which is 60 million on 100 million. We can't tell the scale of things. So sometimes these percentages don't give the full story, which isn't necessarily the best thing. So that's your ARR. The second technique I want to look at today is the payback period, which again is hopefully a nice concept. It's how long it's going to take to pay back the initial investment. And the answer for this will be in years. So how many years is it going to take us to pay back the initial investment? Which again is hopefully a nice, simple concept. Again, going to do a few numbers here. You'll notice this one uses cash flows instead of profits. So we are looking at cash flows rather than profits when we're doing payback period, which is preferable. What I've done here is given you the investment of 650. I've then made up some cash flows here: 200, 250, 175, and 300 across the 4 years. I've then added this cumulative row. And all that is just keeping track of where we're at with this project. So we spend 650. So at year 0, we're immediately 650 down. We then end up with 450. And if what I've done there is you start with your 650 investment. If I then add back 200, because we're earning 200 in year 1, all I've done is just add the minus 650. I've added on 200, and then we've ended up with our 450. So I've just added those together. We're just keeping track of how much we've got. Equally, you then earn back 250 in year 2. So now we're 200 under. In year 3, we earn back 175. So now we're 25 under. We're pretty close to breaking even there. Remember, we're looking at the point at which we get to 0. When do we break even? And then in year 4, we make 300. So now we're on 275. So hopefully you can see that the break-even point or the payback period is going to be somewhere between these two, isn't it? Because we've gone from being under 0 to suddenly we're over 0. So it's some point in between those. Now, if we were doing this to the nearest whole year, you just say 4 years. It's taken 4 years to pay it back. I know we've nearly paid it back after 3 years. We're on minus 25. We're really close, but we haven't yet. So we'd have to wait until year 4 to say it's fully paid back. Some questions and some exams want you to go into that little bit more detail then and actually say specifically how many months has it taken us to pay it back. And if you assume that we earn this 300 back evenly throughout year 4, so it's spread out nice and evenly across the year, we can guess roughly how many months through the year we need to get to. Now, we only need 25 to break even, don't we? So we only need 25 more to get back to 0. So what you could say is throughout year 4, we only need to go 25 over 300 of the way through the year to get back to 0. So that's a very small amount. So we're going to say the payback period will be 3 years plus 25 over 300 of a year. And if we want to sort of talk in more plain English, if we want to turn that into months, what we'll do is 25 over 300 times 12. So that ends up being exactly 1 month. Now with that, you'd always want to round up. So if it came out as just under a month, we'd want to call it a month. But equally, if it came out, say, as 1.2 months, you'd want to be saying, actually, we're going to round that up to 2 months, because if we said 1 month, it wouldn't quite have paid itself off yet. So you're always going to round up with payback period, always go just beyond where you need to be, just to make sure it's paid off. So in this situation, the payback period ends up being 3 years and 1 month. So that's how long it will take to get back to 0. So let's think about some advantages and disadvantages. We're using cash flows, as we said, which we prefer. Nice, easy concept to explain to people. This is how long it's going to take you to pay back what you invested in it. Really nice concept. So even for non-financial managers or people, maybe not even financially minded, this is a nice one to be able to explain. And it also links to liquidity. Now, liquidity is all about cash. So the shorter the payback period, the better for the company. The shorter your payback period is, the quicker you're breaking even, the better. So it does link to getting that cash back into the business, which a lot of investors will like, because they'll think, right, we want our cash back quickly from this investment, please. Now, one of the big disadvantages is the fact it doesn't consider the whole project, because anything beyond that payback period, once you've got to that payback period, we're done with payback period. There might be cash flows beyond that. There might be year 5, year 6, year 7, all these cash flows coming in. It doesn't think about those. Once you get to your break-even point, once you get to 0, it's finished. So you might be turning away some amazing projects that have really big cash flows in the later years, because you're just looking at the payback period. So it's not great from that. It's not looking at the overall profitability of the project. It's just looking at how long it takes to pay itself back, which is, maybe not the best. This method that we've looked at here ignores the time value of money as well. So that idea of discounting things back to their present value. Again, we haven't done that yet. There is a technique called the discounted payback period, which does do that. So you just have to look out for that, which is a slight improvement on this method. And also, there's not a clear decision. The answer is coming out in years, isn't it? It's saying, oh, right, your payback period is 3 years and 1 month in that question we just looked at. Well, should we do the project then? I don't know. Is that a good project? I don't know. I'm not sure. So it's not a clear, decisive yes or no, or this is risky, this isn't. It's still then up to managers and so on to decide whether it's worthwhile. So it's not a really clear-cut black and white decision, which is a bit of a shame. Now, of all the investment appraisal methods we look at, NPVs are the best. They are all singing, all dancing. They tick all the boxes. A lot of these weaknesses we've been discussing get fixed using NPVs. So they are the most thorough, most detailed, most widely used. They're brilliant. They're really good for investment appraisal. And as a simple concept, it's just the present value of all the money you're getting in from a project, less the present value of all the money you're spending on the project. And just to remind you, if that ends up being positive, you should accept it. And if it ends up being negative, you should reject it. If it's exactly 0, by the way, that is at the break-even point, which we'll look at shortly. But so if it's 0, that's the break-even point. But in simple terms, if it's positive, what that means is your inflows are greater than your outflows. So yeah, let's do it. It's going to make us money. Whereas if it's negative, it's the other way around. The outflows are greater than the inflows. It's not worth it. And at the break-even point, your inflows and your outflows are the same. So it doesn't really matter. So that's the decision criteria. So that's a really nice, like we said with payback period, not a clear decision. NPVs give you an answer. At the end, it says yes or no. Shall we do it? Shall we not? It's a really, really clear-cut decision. So let's have a look at a little example. So I'll just get rid of that and bring up some numbers. So we've got our initial investment, we've got our cash flows, so just the same as the payback example then. What I've then done is discount those cash flows using a discount rate of 10%. So these are what we call the discount factors: 1, 0.909, 826, 751, and 683. You can get those often in most exams. You'll get given some tables that give you your discount factors. So how to turn those cash flows into their present values. So just to remind you, for example, what this is doing is it's saying, right, if we're getting 300 in 4 years' time, that's not worth 300 today because of this time value of money. So what I'm going to do is discount it using this rate of 0.683. And in today's terms, that's worth about 205. So 300 like pounds or whatever in 4 years' time is worth about the same as 205 today. So we're getting all these things back into their present values. Now, as a quick, you can use your tables to get those discount rates. Something I like doing, especially if you're using software in this exam, which again, a lot of qualifications are now. What you can do is you can do a little trick, which is equals 1 plus the rate to the power of, which is this little shift 6. And then you do minus the year. So if you do 1 plus the rate, and then that's the little top hat, shift 6 on your keyboard, and then do minus the year, that will work out the discount rate for you. So for example, here, that would be equals 1 plus 10% to the power of minus, and then I click on that cell there. So that would be minus 0 in this situation, and that'll give you 1. And then if we do year 1, it will do it to the power of minus 1. So that'll give you 0.909, etc. So that's a nice little shortcut. And what you can do then is just drag that formula across, and it will just fill in your discount rates for you. So much quicker. And that also helps if the discount rate isn't in your tables. So if it's an odd, if it's 12.3% or something, this will still work. You can still use it. So that's a nice little way to get those discount rates. Right, once you've done all that and you've got all your present values, we just need to add them up. So if you just add up all of these present values, so the MPV is just the sum of those, which comes out as plus 75. So in this question, the inflows, all those positive numbers in year 1, 2, 3, and 4, add those up, they are exceeding the investment of 650 by 75, and therefore it's worth it. And that's a really nice little way to do it. And you should always comment on your MPVs if you can. I would say accept the project as a positive MPV will increase shareholder wealth. So that's a nice little phrase to use there. Because it's positive, we should accept it. Now, in terms of good things, it's an absolute measure. And what that means is the answer will be in pounds or dollars or whatever currency you're doing your MPV in. But it tells you how much this project is going to make you. It's quite factual. An absolute measure is nice. This is how much money it's going to make us. This is by how much it will increase shareholder wealth. Rather than a percentage or years, which are all relative and open to interpretation. It's much more factual, which is great. It does take into account every single cash flow. The whole life of the project is taken into account. It does also consider the time value of money. That's another one that's not here on the list, but it does think about discounting things, which is good. And as we said, there's that clear accept or reject decision. So remember, if it's positive, you accept it. If it's negative, you reject it. But at the end, there's an answer. Yes, we will do it. No, we won't. Now, these NPVs are really dependent on that cost of capital. Now, I just used a discount rate of 10%, which would be the company's cost of capital when you're doing this. That's a whole other masterclass. I'm recording a masterclass on the cost of capital, so that'll be available as well if you need to look at that. That cost of capital is based on a lot of assumptions. There are a lot of things that go into that mean it's a little bit approximate. And if you change that in an NPV, it massively can cause the NPV to change. So I used 10% in that last example. If I use 12% instead, for example, the NPV would be much lower. So there is that reliance on that, very sensitive to changes in the cost of capital. It's also quite complex to explain, especially to people who aren't financial managers. So whereas with payback period, you say, oh yeah, it's the time it takes to pay back the initial investment. Great, we get that. Yeah, nice, easy concept. With this, you're saying, right, what I've done is I've taken the present value of all the forecast cash flows for the next 4 years. I've deducted the present value of the outflows forecast for the next 4 years, discounting them using the company's cost of capital. And because the inflows exceeded the outflows, I think we should go ahead and do this project. And you can just imagine a non-financial manager going, what have you just said to me? I've got no idea what you're on about. Whereas with payback period, it's going to take 3 years to pay itself off. Great, I get that. So it's going to be quite hard to explain potentially to people who aren't in this, don't work in this area. It does rely on forecasts. So yeah, we're predicting what sales are going to be in 4 or 5 years' time, which is almost impossible to do. That's true of all of the investment appraisal techniques, to be fair. There is an element of forecasting and guessing what we expect to happen, but it feels with NPVs we're a lot more detailed with NPVs. So yeah, there are a lot of forecasts going on in there, which again are based on estimates. So that's it for NPVs. Overall, brilliant method, really widely used, heavily examined in all financial management papers. So yeah, very, very common. So you need to be all over that. And again, I am actually going to do a masterclass on exam technique of the bigger NPVs as well. So there is going to be more content available from Kaplan on doing NPVs and a few tips for the bigger ones of those. The fourth and final one I wanted to look at in this session, though, was the IRR. And that is the discount rate at which your NPV is 0. Now, in that last question, with the NPVs, I did it at 10%, didn't I? And the NPV came out as plus 75. What we're looking at now is what rate would have meant that the NPV is 0. So what I often call this is the break-even discount rate. So I think that's actually a nicer name for it. Apologies for my dodgy writing, but the break-even discount rate is what I actually prefer to call this. It's the discount rate at which your NPV comes out as 0, rather than it being actually a rate of return. So if we look at this example with some cash flows again, so same thing. What you can do in Excel and in a lot of the exam software now as well is to use this IRR function. So if you highlight these cells, don't worry about the years, just those, and it's the cash flows. It's not the discounted cash flows. It's the ones before you've discounted anything. If I do equals IRR and click on the left one and drag it across, that will tell me what the IRR is. And you can try that again, try it in your exam software, but it will work. And that comes out as 15%. So if you do it again, you can do it in Excel if you want, it does work. So equals IRR, just highlight those cells and it will tell you what the IRR is. Now, there is another way of finding the IRR, which is this linear interpolation, which involves doing 2 NPVs. So you use a higher rate and a lower rate, and there's a formula you can use to do that. That's a lot more approximate. It's a lot more guesswork, and it's a bit of a faff. So again, I much prefer, if you are able to use this in your exam, then I would recommend doing it. So just to prove to you that this is right, so we've said, right, 15%. If we discount this using 15% now, we should get an NPV of 0. So just to prove it to you, I've done that. So I've done my 15% discount factors. Again, you could use that little formula I showed you earlier, or you could use tables if you get them to get those 15% discount rates. And if you discount it at 15%, add it all up, the NPV, sure enough, comes out as 0. Now, that's really nice for this company to know, because they know, right, at the moment, their discount rate, what was it, 10% we used earlier? We've got a little bit of leeway then. It can go up all the way up to 15% before we break even. If the company's rate is 16% or 17%, this is going to go into negative territory at the NPV, and therefore it shouldn't be worth doing. So 15% is like the turning point from it being a good project to a bad project. So it's a really nice point to know. Now, in terms of the IRR, it does use cash flows as well, which is great. The whole life of the project's taken into account. And you don't need to know the cost of capital. This is working out that break-even point. So it doesn't need a cost of capital to be able to calculate it. So we're not reliant on that, which is quite useful. Unfortunately, it can produce either 0 or multiple answers if you've got irregular cash flows. So if you've got a project where you invest at the beginning, earn a bit of money, then you have to invest a bit more, then you earn a bit more, invest, earn, that can give you several different answers for the IRR, which obviously isn't ideal and quite confusing. Or if it's an amazing project, it might not have an IRR at all. There might not be one. So it's not necessarily the clearest cut. And there is something called the modified IRR, which you may come across in later studies, which is an improvement on that. I also think the name is a little bit misleading. It says it's a rate of return. It's not really a rate of return. It's the discount rate at which your NPV is 0. So if you said the IRR is 10% to someone, or 15% it was, wasn't it, in this one? Oh, right, the internal rate of return of is 15% on this project. They'll think, okay, right, that means it's returning us 15% a year. That's the accounting rate of return, really, isn't it? That's something different. What this is we're saying if you use 15% as a discount rate, then it will break even. So it's a little bit misleading. And also, again, it's a relative measure. It's a percentage, which, as we've talked about, has its advantages and disadvantages, but means that you don't know exactly how much money it's going to make you. So this should really be used in conjunction with the NPV rather than instead of. So it's a nice thing to do side by side. So do an NPV and work out the IRR. That's a great combination. Right, that's it for those 4 investment appraisal techniques. Hopefully that's been useful as a quick overview of the main methods that we see. As I said, there are further masterclasses going to be available in terms of NPVs and also the cost of capital as well. So plenty of other things to help you. But hopefully that's given you a bit of a start on investment appraisal. And I wish you good luck with the studies.